on these rate cut expectations. I'm actually surprised that gold didn't sell off more than it did. It was down about $70 on the day, but it was already down about $40 or $50 before the press conference. So for all intent and purpose, it was at a record high yesterday. And, so it didn't really come down that much given how hawkish I believe the Fed was. And the dollar rallied, but, it wasn't that big a rally given this. So I don't know if it really shows how weak the dollar is and how strong gold is. Both markets shrugged off this hawkish Fed, or maybe the markets haven't really connected the dots to what Powell just said. Maybe it's going to take a day to set in, and then we're going to start to see a bigger reaction. The final thing.
Economist and gold advocate Peter Schiff has issued a stark warning regarding the future of the US dollar, suggesting that America's economic system may collapse. In a recent post on the social media platform X, Schiff highlighted unsustainable trade deficits and fiscal mismanagement as key factors threatening the stability of the U.S. financial system. He forecasts a sharp decline in the U.S. dollar, arguing that the only way to address the nation's massive trade imbalance is to eliminate the dollar's status as the global reserve currency. Such a shift could result in gold reaching unprecedented heights, positioning the precious metal as a potential hedge against the dollar's decline. Despite recent fluctuations in gold prices, Schiff views the metal's strength as a clear indicator of the underlying weakness of the dollar. He notes that gold prices have shown resilience even when the Federal Reserve adopts a more hawkish stance by raising interest rates. A recent pullback of $70 in gold did not interrupt the overall positive trend, with the price surging by as much as $100 within just 2 days. Schiff interprets this market behavior as a sign of growing skepticism about the dollar's long-term stability. He points out that the gold and currency markets are signaling an increasing lack of confidence in the dollar, which may indicate a broader shift toward alternative stores of value. In addition to his concerns about the dollar's future, Schiff has criticized Federal Reserve Chair Jerome Powell's comments regarding the Fed's influence over supply-side issues. Powell has dismissed the idea that the central bank could address these challenges, maintaining that its mandate is confined to managing demand. However, Schiff disagrees with this assessment, arguing that the Federal Reserve plays a crucial role in balancing supply and demand through its control of interest rates and money supply. During periods of supply shortages, the Fed should tighten the money supply to reduce demand and prevent an overheated economy. Without a dramatic shift in policy, the U.S. economy will continue to face challenges, and both the dollar's decline and the rise of gold will intensify. Now, we present the clips from Peter's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
I'm actually surprised that gold didn't sell off more than it did. It was down about $70 on the day, but it was already down about $40 or $50 before the press conference. So it wasn't that big a sell-off. And, gold was at 34.30 yesterday. In fact, GLD yesterday closed, I think 2 or 3 cents below its record high close from a couple of weeks ago. So for all intent and purpose, it was at a record high yesterday. And, so it didn't really come down that much given how hawkish I believe the Fed was. And the dollar rallied, but, it wasn't that big a rally given this. So I don't know if it really shows how weak the dollar is and how strong gold is that, both markets shrugged off this hawkish Fed, or maybe the markets, haven't really connected the dots to what Powell just said. Maybe it's going to take a day to set in, and then we're going to start to see a bigger reaction. The final thing that Powell said that I thought was really ridiculous at the press conference, and really shows you, maybe he is that clueless when it comes to, basic economics. And I've always thought, like, in order to get a job at the Federal Reserve, you got to flunk a test in basic economics, right? Only the people that fail the test, right, get to work at the Fed. If you pass the test, they won't even consider. So I'm talking about the press conference with Jerome Powell. So a question he got had to do with, isn't he concerned about supply shortages coming from the tariffs? Because, all the ships that normally bring Chinese goods to port, they're not showing up, or they're showing up half empty. And so there's not going to be enough goods, right? It's another COVID-style supply shock. Only this time it's not the pandemic, it's the tariffs. And he said, well, he's not really thinking about that, or, he doesn't seem to think that it's material. And I think the reporter said, well, would you do anything? Like, how would you respond to this, right? And Powell's answer was, well, it's beyond our mandate, because he said our policy tools only affect demand. He said we can't do anything about supply. And so, that's going to be up to the Congress to get involved. We just have no role. And of course, he's completely wrong. I mean, maybe Powell doesn't understand supply and demand, again, which proves that he flunked the test on economics in order to get the job at the Fed. Because he absolutely can have an impact on supply, because supply and demand work together. So if there is a supply shortage, what Powell's job is to address that from the demand side. So if supply goes down, the Fed needs demand to go down, right? That way the market stays in an equilibrium, right? So if there's less supply, okay, well, let's have less demand. Powell absolutely can address that. So what would be the appropriate response if all of a sudden there were a lot less goods for consumers to buy? Well, Powell needs to tighten up on the money supply, raise interest rates to reduce demand so that demand comes down along with supply. That's what he should do. But of course, he's never going to do that. He's not going to hike rates. He's not going to reduce demand. That crashed the economy. But that's really what the Fed's supposed to do. In fact, I mentioned this on the podcast. When the Federal Reserve was first created in 1913, that was precisely what it was supposed to do. It was supposed to have an elastic money supply that expanded and contracted along with the economy. So if the economy was booming and there was excess supply, the Fed was supposed to allow money supply to grow. But if the economy was contracting, if supply was going down, the Fed was supposed to suck that liquidity out so that money supply came down with the supply of goods. So to keep the two, in harmony. So Powell absolutely has the ability to react to changes in supply by changing demand and then changing where the supply and demand curves intersect. So he doesn't even understand how monetary policy works or how supply and demand, right? This is the most basic laws of economics, the interplay between supply and demand and how one affects the other. Anyway, let me move on from Powell. Although before I do, I wanted to talk again about the reaction, because gold was up $100 an ounce yesterday after being up $90 an ounce on Monday. So you had a $190 two-day move, and now we had a $70 pullback today. But the trend is clearly up, and I think what sparked the pullback was the optimism about trade talks with China. But also, not just in the foreign exchange market, over the last week, you had a two-day 9% surge in the Taiwan yuan. I mean, that is rare to see that currency move that dramatically. Now, it pulled back about 3% the third day, but still, it held on to a 6% gain very quickly. And again, this is another sign of the dollar breaking down. And the dollar has, much further to fall.
As the threat of stagflation grows, Federal Reserve Chair Jerome Powell acknowledges that rising unemployment is likely to occur as the economy weakens. He states that the Fed will focus on whichever of its two mandates, price stability or maximum employment, is drifting furthest from the target. However, this strategy presents a serious dilemma. Cutting interest rates to fight unemployment could worsen inflation, while raising rates to curb inflation could push more people out of work. With persistent inflation and job market pressures mounting, the Fed finds itself in a dangerous tug-of-war. Each move to fix one problem risks intensifying the other, leaving Powell in a precarious position where no clear path offers relief. Peter Schiff strongly criticizes Powell's strategy, arguing that the Fed is now trapped in a no-win situation. According to Schiff, years of relying on easy money policies like low interest rates and quantitative easing have cornered the central bank. Raising rates could crash the financial system, while cutting them could send inflation soaring. Schiff predicts the Fed will eventually choose to support the labor market over fighting inflation, but warns this will only backfire. If the Fed pumps more money into the economy to reduce unemployment, it may trigger even higher inflation, eroding purchasing power and slowing growth even further. Let's get back to the video.
The risk is that we have higher inflation and we have higher unemployment. Now, given that, how is Powell describing the economy as being in a great place? How is he saying that inflation is in a great place? How is he saying that the labor market is in a great place? Doesn't sound like a great place to me. I mean, a great place would be that the odds of higher inflation are going down, right? That sounds like a great place, not where the odds are going up or the odds of higher unemployment are diminishing, right? That would be a good place. But when you're admitting that the odds that of higher inflation are going up, that's pretty far from a great place, especially when both of them, the Fed didn't say the risk of higher inflation is going up, but we feel okay about employment, or the risk of unemployment going up, but we're not worried about inflation. No, the Fed admitted that the risks are rising for both simultaneously. So in other words, the risks of stagflation, because unemployment is going to rise because of a weak economy. And either the increase in unemployment causes the recession, or the recession is caused by the rise in unemployment. But either way, Powell is describing elevated stagflation risks. That sounds like the farthest thing from a great place, especially since the Fed really doesn't have a plan for stagflation, although now it claims that it has a plan, right? The plan that it has now is to figure out which one of its mandates is farther away from where it's supposed to be and then focus on that one. But I don't even know how they do that. I mean, how do you tell? Let's say unemployment goes up to 6% and, where it is now in the fours. But if inflation goes up to 4 or 5, I mean, which mandate are they farther away from? I mean, it seems like they're about the same. I don't know how you know which problem is worse, the inflation problem or the unemployment problem. I mean, they may be equally as bad. So I don't think the Fed's plan is going to work, especially, and Powell had to reluctantly acknowledge this, but whichever mandate it chooses to focus on, right? So if the Fed decides unemployment is the bigger problem than inflation, even though inflation is a problem, if they try to solve the unemployment problem by cutting rates or doing QE, they make an already bad inflation problem worse. And what if making the inflation problem worse actually undermines the economy and causes unemployment to go up, even though that's the mandate they're pursuing? Conversely, right, if they end up saying inflation is the bigger problem than unemployment, and they jack up interest rates to fight inflation, well, now unemployment goes up, and now that might be the bigger problem. So what do? Just back and forth? Every time they fight one problem, they make the other problem worse, and then they have to turn their attention to the problem they just worsened and then make the other one worse again, right? There is no way out of it when you're in this situation, because none of this has ever worked, because the Fed was always able to get away with creating inflation to solve problems, or to pretend to solve problems. It was really just sweeping them under a rug. But it's not going to be able to get away with it anymore. I believe that, the Fed is going to ultimately decide that it's the labor market and the economy that need help. Inflation be damned. But it's going to backfire, right? It's going to weaken the economy further and create even more unemployment as the inflation rate is rising.
As the threat of stagflation looms larger over the U.S. economy, with persistent inflation, slowing growth, and the risk of rising unemployment, gold is increasingly regaining its traditional role as a safe haven asset. Investors are growing skeptical about the Federal Reserve's ability to effectively navigate this economic crossroads, where every policy move seems to worsen one side of the problem while failing to resolve the other. If the Fed lowers interest rates to support employment, it risks reigniting inflation. Raising rates to control inflation could deepen economic contraction and increase job losses. This policy paralysis erodes confidence in the Fed and the broader financial system. In such an environment, gold stands out as a stable and trusted store of value, immune to the dilution that plagues fiat currencies and unaffected by the political compromises central banks often make. As uncertainty deepens and traditional assets face volatility, many investors turn to gold as a hedge and a critical shield against systemic risk. That's it for today. Share your thoughts on Peter's analysis in the comment section below. If you find this video informative, don't forget to support and turn on notifications to stay informed about our latest videos. See you in the next video. Thanks for watching.